All right, welcome back to another edition of Financial Accounting. Happy Wednesday. It's April 28th. We're going to talk about 11.3 today. We'll probably have a little bit left over at the end. We'll pick it up again on Friday. I'll happy to help you out on the questions, your homework on Friday, and maybe talk a little bit about the review that will definitely be taking place on Monday, May 3rd. We have a final exam coming up here. So it's almost the end of the term. So if you're in section 006, we meet at 12 p.m. Your final exam is going to be on Tuesday, May 11th at 7:30 a.m. If you are in section 007, we meet at 2 p.m. Your exam is going to be Friday, May 7th at 1:30 p.m. If you're in section 008, your exam is going to be on May 10th at 4:30 p.m. And to access your final exam, you simply go to Blackboard like we've done with all of our other classes, all of the other exams, find the final exam folder, boom, click in there, and you will see your final exam link on there. You currently don't see it because it's not the final exam yet, but that's where it will be. Same process as before. Make sure you have the Proctorio installed in your computer, etc., etc. We'll talk more about that, of course, as we get close to the exam. Speaking of the final exam, in the final exam folder, on Blackboard, you will see a set of review notes. I've broken down all 50 questions by learning objective to help you with your review. I'll get some practice questions up for the chapter 10 and 11, which we've been covering for the past couple of weeks. I'll get those up on my accounting lab later next week, probably next week, but as soon as possible. In the meantime, you can go ahead and start going through the practice exam that's already up on Blackboard. Practice that as many times as you want. It's a comprehensive final exam, so everything in the class is being tested. So that is a good way to start seeing what to expect on the final exam. But make sure you look at the review notes first. While you're up on Blackboard, I recommend going to My Grades and checking to make sure that the point total is matching what your performance is thus far. So down below, you see you've had 5 exams, 300 points total. Those plus your homeworks earned to date, plus any extra credit from the extra credit assignment will total what you see for your total course score points earned. That divided by currently, whatever your points are divided by 394, that will tell you what percentage of points you've earned to date, and that corresponds, of course, to your course grade. By the end of the term, total course points will be out of 500. So the key thing here is to make sure you get as many points as possible to get the grade that you need. If I get a 90% response rate on the course evaluations, everyone will get 5 extra bonus points. That equates to about a 1% bump in your overall percentage of course points earned. So please go on to the evaluation site and get those done so you get extra bonus points that way. Also check to make sure all your homework points that I've posted are correct based on what you've earned on my accounting lab. If you have any questions about that, please come and see me and I'll be happy to walk through anything that you need to have answered. So without any further ado, let's go into chapter 11 again. We left off talking about, among other things, uh, the statement of cash flows from a theoretical standpoint. So we need to make sure that we understand what to expect on the statement of cash flows. Generally speaking, statement of cash flows is broken down into 3 sections to determine an overall change in cash, which of course ties into the balance sheet numbers that we see. The information is broken into operating, investing, financing activities. Those activities correspond to certain sections on the balance sheet. So when we're looking at changes in total cash, realize that changes in cash correspond to the changes in all the other non-cash accounts on the balance sheet. We saw that mathematically in the last class where we could see, hey, if we move everything over to the right-hand side, we will see that total cash equals or equates to the totals of all the balances in all the other non-cash accounts. More importantly, the change in cash equates to the change in current liabilities, the change in long-term liabilities, the change in stockholders' equity accounts, the change in the other current asset accounts, and the change in the long-term asset accounts. That's mathematically how it works. We went through an example to see how that worked, but realize our focus here is on categorizing the changes in all the non-cash accounts um, in terms of operating, investing, and financing activities. Current assets, current liabilities, changes in those accounts are what we're going to report in the operating section. Changes in the long-term assets, we're going to see that in the investing activities. Everything else is going to meet in the financing activity section. So go back and take a look at your notes and just realize at the end of the day, what we're looking at here is trying to uh, break out the changes in cash according to the changes in all the non-cash accounts. So 11.3 tends to be a little bit dense and a sticky subject. So we're going to take some time to go through this here. The book shows you all the different ways we account for changes on the balance sheet accounts. But I think that we need to start with the less difficult section first. The less difficult section of the statement of cash flows relates to the investing activities and the financing activities. The reason why this is less difficult to fill out is because we don't see a lot of activity or very many transactions involving investing activities or financing activities. By that, I mean, we're not always issuing stock day in and day out. We issue stock maybe once throughout a company's entire life cycle. We're also not constantly buying and selling long-term assets every day. What we are doing is selling goods and services throughout the day, every single day. So we have millions of transactions related to our operations, not that many related to investing activities or financing activities. So let's talk about the cash from operating activities last. Let's start with investing activities first. Realize that long-term assets, changes in long-term assets, relate to investing activities. So if we're making pizza, we need pizza ovens. We need equipment to bake and sell pizza because, hey, the oven generates revenue. Revenues are the return on our investment. We can also buy stocks and bonds. Those can also be considered investing activities. If we loan money out to others, those are notes receivable. That's another type of investing activity. But generally speaking, when we're talking about changes in long-term assets, we're talking about changes changes related to investing activities that are that affect cash one way or the other. So when you think about changes of long-term assets, say for instance, we see an increase in our land account, it will help to think about a transaction or a journal entry that would affect cash. If we saw an increase in land, how might cash be impacted by that? Well, if we see an increase in land or equipment or buildings, think from just a general perspective that maybe we bought that with cash. It's going to help you to not overthink these transactions. But generally speaking, you want to think, hey, what would be one transaction that would cause an increase in my long-term assets? Maybe a transaction where we paid cash, in which case, if you see an increase in equipment or land or buildings, it generally means that there was a cash outflow. If you see a decrease in any type of long-term assets, probably we sold it to get cash. That's generally the perspective I want you to kind of keep in mind when you go through and try to analyze changes in these different balance sheet accounts. Inflows will probably come from selling long-term assets. Outflows are as a result of buying long-term assets. What about financing activities? Things like long-term notes payable or bonds, or say for instance, any type of stock transactions or dividend transactions. Fortunately, these tend to be pretty intuitive. Again, they don't happen very often, but when they do, we can usually sort of intuitively derive what possibly could have affected, how these transactions could have affected cash. So in the case of issuing stock, or let's actually look down below first here. In the case where we issue stock or we issue bonds or we get into debt, those accounts are increasing. Why do we get into debt? Why do we issue stock? To derive cash. So the cool thing about this is if we issue anything, stocks or bonds or whatever, generally we can think of a transaction that could affect cash, in which case we would see an increase in cash if we issued those things. That's why the rules up above are positive. We issue stock, we probably got cash. When we borrowed money, we probably got cash. What if we paid out dividends or purchased treasury stock or paid off notes payable or bonds payable? The idea behind here is paying something, paying out cash is going to reduce the cash account. That's why you see purchase is a negative flow. Payment is a negative flow. These are pretty intuitive. We're going to put in negative numbers to represent payments, positive numbers to represent proceeds. Operating activities is a little bit tricky. Now, the reason why is because, well, we're going to be using the indirect method of the statement of cash flows. And the indirect method primarily has a very different cash from operating activities format than you see under the direct method. For the exam, you're primarily responsible for knowing the indirect method. So that's what we're going through here. That's what you're practicing throughout the chapter. The indirect method starts with net income because it's a close approximation of cash from operating activities. Granted, we know that revenue can be recorded on account, meaning that, hey, we earned revenue, but we didn't get cash, we recorded an account receivable. We also know there's lots of expenses that affect net income that could be just accrued and not necessarily paid. So when we're starting with net income, we know it's a close approximation of cash from operating activities because cash, in fact, affects operations. But what we need to do is pull out of net income any non-cash transactions. That's the idea. So when we start with net income as our first number, net income is going to be a positive number. Net loss is going to be a negative number. If we start with that, we want to make adjustments to extract any non-cash, the effects of any non-cash transactions. First way to do that is to cherry pick from the income statement those items that we definitely need to reverse or pull out of net income. The biggest one that you almost always see is depreciation expense. And the reason why is because depreciation expense, we know now, is a debit that shows up on the income statement, but the credit is never cash. It's always accumulated depreciation. So when we're recording depreciation expense, yes, net income goes down, but that does not affect cash. So if that is an expense that reduces net income, and it's a non-cash transaction, let's reverse it out by adding it back in. That's why depreciation expense is added as an adjustment to net income. Losses and gains from the sale of long-term assets, those also have to be reversed out as well. And the general idea behind this is depreciation on equipment, gains and losses from the sale of equipment. Those do have cash effects, but those cash effects are recorded in the cash from investing activities section of the statement of cash flows. So one of the reasons why we're removing them from net income is because one, they're on there. Two, they're not operating activities. And three, any cash flow effects related to these things are shown in the investing activities section when we talk about purchase of long-term assets or the proceeds from the sale of long-term assets. Bottom line is the income statement has investing activities stuff that we just want to remove from net income. So we're just going to reverse it out. Then comes the more challenging part. And the reason why this is challenging is because a lot of these things aren't very intuitive. So here's a couple shortcuts. If you need to memorize how to interpret these changes in current assets and current liabilities, I recommend trying to memorize the changes in current liabilities, because you see that if there are increases to current liabilities, we want to reflect those changes as positive numbers, decreases reflect those changes as negative numbers. Assets act the opposite way. You're going to see their increases are minuses, decreases are pluses. That doesn't make intuitive sense, which is why I recommend this tip. Instead of trying to memorize these changes, think about transactions, a single transaction that would cause these changes. That will help you remember what to do with how to treat these changes on the statement of cash flows. Again, realize we're making adjustments to net income. So these aren't necessarily changes that affect cash. All we need to do is remember the rule by thinking about a transaction. That makes a lot of sense. So think about decreases first. What would be a decrease to a current asset that could affect cash? Number one example I think about is a decrease in accounts receivable. If I see a decrease in accounts receivable, the journal entry would require, an increase to cash. That's how I remember a decrease to current assets needs to be reflected as a positive number on the statement of cash flows. It's just a rule. The journal entry that I think about helps me remember that rule. What if I see a decrease to current liabilities? What would be an example of a decrease to current liabilities that could affect cash? Well, pretty much you pay down anything, any type of payable that you pay off decreases that current liability. As a result, it also decreases cash. So I always remember that decreases to current liabilities need to be reflected as negative numbers on the statement of cash flows. That's the rule. There's the example. That's how I keep these things straight. What if, though, it's the opposite. What if these are increases to current assets and current liabilities? Well, you just simply do the opposite of what you see up above. If you see an increase, do the opposite of what happens with a decrease, or however you want to remember it. Here are some other examples you can think of. Well, an increase to current assets. Well, how would that potentially affect cash? Think of this example. I I prepay my rent. That account, that current asset account increases. What would be the corresponding part of the journal entry? A decrease in cash. So if I can remember that rule, I see an increase in current assets. I can think, okay, I need to subtract that change on the statement of cash flows. What if I see that liability has increased? So one example would be unearned revenue. People paid a deposit, paid a down payment because they wanted to rent a wedding a facility for their wedding reception, say 6 or 12 months in the future. Fine. I got that cash now. Cash goes up. Liability also goes up. Unearned revenue represents that liability. I owe that money back to my customers if I don't provide them that service. So I can think of these journal entries, situations in which cash would be impacted by an increase in current assets or current liabilities, and therefore think to myself, how should I represent that or reflect that on the statement of cash flows? These are the rules. You just need some examples to think about to help you remember those rules. Otherwise, it's just memorization, and memorization can get you into trouble. Let's talk about an example where we are given random information and we need to sort it out. This typically is what you're going to see on the exam or on homework problems. They give you either information from the balance sheet or from an income statement. You need to know how to sort it out, or they tell you it textually. If they just put it in a paragraph, you need to know what to do with it. So if we're doing the indirect method, we know at the very top, we're going to start with net income. So there's the 50,000. Now this is net income. If it was a net loss, I put this in brackets to represent a negative number. So that's 50,000. That's abbreviated, of course. If it was a net loss, I would show it as a negative number. Okay, just to keep my numbers straight. But this is the reason why the cash flows from operating activities is strange, because these are not necessarily cash inflows or outflows. This is net income, and we need to make adjustments to net income. So when we do that, the next step is to start cherry picking from the income statement those items that need to be reversed. We need to reverse out the effects of any depreciation by adding it back. We're always adding that back. Gains increased net income. We need to reverse that out with a negative, and that's why we see those numbers represented there. Once you figure out those depreciations, gains, and losses, then the next step is to move on to changes in current assets and current liabilities. Now, again, for me, I try to remember a rule. If I see a decrease in a current asset, that generally could correspond with, like, say, a decrease in accounts receivable. That would result in an increase to cash. I can remember this rule just by thinking up an example. So, do I see any decreases in my current assets? Well, here's one. Inventory decreased by $3,000. All right. That to me means I must have gotten cash. I'm just following the rule here. I'm not trying to analyze the specific accounts. I'm just trying to follow the rule. This went down, therefore, throw it in as a positive number. So go down to inventory and throw it in as the change is a positive 3. Just follow the rule. If I see the opposite, do the opposite. This change was 15,000. This change was 1,000. Pop those in as negative numbers. Again, these don't necessarily represent cash flows. You're just trying to interpret the changes by thinking of an example of an increase or decrease that would affect cash. We can do that if we want to. Prepaid expenses, those increased. That would be a debit to the prepaid expenses. I would credit cash. So that makes sense. An increase to current assets is a decrease to cash. So negative numbers are all I really need to do, all I really need to associate with these changes in current assets. These are just rules these are just tips to help you remember the rules. And they work. Current liabilities. So if I think about a decrease in some type of current liability, maybe it's a decrease in accounts payable, for instance. If I pay off a liability, generally speaking, that means I'm going to decrease cash. So all these things, all these changes can correspond with the number I need. I have an increase, therefore I need to represent the change as a positive. I see a decrease, I need to represent the change as a negative. And that's what I'm doing down below. Increase in accounts payable, put it in as a positive number. Decreases, put them in as a negative number. Now, again, it doesn't necessarily intuitively make sense to say, oh, I have an increase in accounts payable, therefore I have $34,000 cash inflow. That's not the way to interpret this. These are all just adjustments, not literally cash flows. We know that there are increases and decreases to accounts payable. Here, we're simply saying that there was a net increase in accounts payable. How do we interpret that? Well, the rule says when you have an increase in current liability, plug in that number as a positive number. Think of a transaction in which that would make sense. That's how you can remember. Otherwise, just memorize the signs. Decreases are always going to be minuses. That's why I put those in as decreases. Again, there is logic behind this, but I don't want you to overthink this. Once we get all of the amounts, the adjustments, these are all just adjustments, then we want to net those. And the net here is going to be a positive or negative. It's not necessarily a cash in or cash flow, cash in or cash out. This is a positive number. We want to take that net income number and add 27,000 to it to get what it can be truly interpreted as a cash flow from operating activities. That 77,000 can literally be interpreted as a cash inflow because it's positive. It is the net income restated as a cash basis net income. Up above the 50,000 was an accrual basis net income number. The 77,000 is what our net income would look like if we were a cash basis accounting preparer. So we have a $77,000 cash from operating activities. We can literally interpret that as a cash inflow. All the other numbers, I want to caution you about this, all the other positive, negative numbers are not cash flows. They're just adjustments to net income. Only that 77,000 should be literally interpreted as a cash flow. By the way, when we look at the $50,000 net income and the $77,000 cash basis net income, why are they different? They're always going to be different. And they're different for a variety of reasons. One of the reasons why net income might be lower than cash basis net income is because depreciation is always something that we see on the income statement that doesn't affect cash. Also, cost of goods sold is a non-cash transaction too. It's an expense, in which case we debit cost of goods sold. It's an expense, and credit the inventory. That's never a cash transaction. Is there a cash impact? Yes, but there's a timing difference between when we accrue for expenses and when we actually pay for these expenses. So generally speaking, we're never going to see these guys equal each other. They're always going to be different because the timing of when economic events happen and when the cash effects actually flow through our accounting system. So just be aware they're always going to be different. The simpler portions of the simpler, not simple, but simpler portions of the statement of cash flows are the investing activities and financing activities. Generally speaking, the information is going to be given to you in a very intuitive way. So if we say we purchased something or we loaned out money, that's going to mean a negative number, a cash outflow. So we can quite literally show those as negatives. Those are interpreted as cash outflows. Proceeds from receipts generally means that we got cash in. So proceeds from the sale of plant assets, that receipt can be shown as a positive number. You net those together, you have literally a cash outflow. So negative numbers and positive numbers can, throughout this entire section, can be interpreted literally. This is a pretty big outflow here. This is a cash outflow. We typically see, when we look at a statement of cash flows, a negative number from the cash from investing activities, because we expect to see companies invest money in themselves. We expect a company to continually grow. So therefore they need to buy buildings, they need to buy land, they need to buy equipment, et cetera, et cetera. So you're always going to see a negative number from the section, a general cash used for investing activities. And by the way, here's just something to think about too. If we see an increase in equipment, generally it's okay to imply to look at that and say, oh, that must be a cash outflow. But what if we purchased equipment by issuing a note payable? That's a non-cash transaction. We'll talk about that later. So just keep that in the back of your mind for right now. Cash from financing activities. Again, this tends to be pretty intuitive. We issued a note payable. We issued common stock. Why did we do that? Because we wanted to get cash. We made a payment on a note payable. We paid out dividends. These things, they're payments, so cash went down. So the cool thing about it, this section, is that you can quite literally interpret what's going on by just reading the sentences. Proceeds means cash in, payments mean cash out. You net those out. In this case, we have a net cash provided by financing activities. And just like the investing activity section, we can literally interpret each one of these as positive numbers, cash inflow, negative numbers, cash outflow. It's really nice. Put them all together, what do you have? Well, we take the cash from operating activities, net it with investing activities, and add the financing activities. What do we get? A net decrease in cash year over year of 8,000 in this case. Does that make sense? Well, if we look at the balance sheet, we can see the beginning cash balance, which is last year's ending, was 42. And we see the ending cash balance for the current year is 34. So we can look at this and say, oh, there was a decrease of 8,000 year over year. Guess what? That matches our changes in the cash account per the statement of cash flows. And then from there, we take the 8,000 change, we add the beginning balance, and that gets us our net. It's a way of sort of representing the roll forward of cash. What was beginning or the changes, here's the ending cash. And then you know you've done it correctly if it ties back to the balance sheet. So that's a good thing. Other considerations, what if we, like going back to that question, what if we bought plant assets using a note payable? So what if we got equipment, but we didn't pay cash for it? We issued a note payable. Well, that would be an increase in investing activities, and the note payable would be an increase in financing activities. But these don't affect cash. So we need to disclose at the bottom of the statement of cash flows, any significant non-cash financing or investing activities. The reason why we have to disclose this is because when investors look at changes in notes payable, they want to see that all the changes in notes payable are shown on our statement of cash flows. They also want to see that all the changes in equipment are shown on the statement of cash flows. So if, for instance, we looked at the equipment account on the balance sheet, current year, prior year, and let's say it went from something like 150,000 to 250,000, right? Well, that represents an increase in equipment of 100,000. If the investing activities, the cash flows from investing activity section says purchases of equipment, and it says there was a cash outflow of 70,000, well, that doesn't account for the full change in equipment. If I see a change in equipment, immediately I'm thinking to myself that I debited the equipment and I credited cash for the full 100,000. That's my first guess. Looking at the balance sheet, equipment increased, I must have paid cash for it. But I didn't. I only paid 70,000 for new equipment. I would have to disclose towards the bottom any significant non-cash transactions, in which case I would say down below, I would say issued 30,000 in notes for equipment, meaning that I got 30,000 of equipment by issuing 30,000 of notes. Therefore, I can say, look, yes, there was a change in equipment of 100,000, but only 70,000 of that was paid for in cash. The other 30,000 increase in equipment, I got equipment by issuing a note payable. So bottom line is all the changes that we see in each non-cash account on the balance sheet is going to be explained on the statement of cash flows, either in the cash from operating activities, investing and financing activities, or at the bottom in a footnote where we say, here are all the significant non-cash transactions. that are due to financing and investing activities. Is there another format of the statement of cash flows, you may wonder? Yes, there is. It's called the direct method. It's not something I generally test, but it's something that we should probably take a look at here. Under the indirect method, which we like for sure, we're starting with net income. And this is by and large what most companies use when they're doing their statement of cash flows. They don't really see the direct method that much. Why do we see the indirect method? Well, because investors can tie back net income to the income statement. They like to see that these statements agree. They tick and tie between the financial statements. If I see net income on here, it better tie the net income I see on the income statement. I can also see on the income statement any type of depreciation or gains and losses. So I can tie that back. I can then therefore look at all the changes in the current assets and liabilities. I can tie that back to the balance sheet. So the cool thing about the indirect method is that all these things tie back to other financial statements. So why not produce the statement of cash flows by referring back to the changes and the information on the other financial statements? It makes investors happy to see how it all kind of ties together and makes sense. The direct method requires a lot more information to complete the cash from operating activities. The CFOA section is very, very, very different from what we see up above. They have a title, subtitle, receipts and payments, and they quite literally say, here are the collections from our customers. Here's the interest we received. Here's how much we paid to suppliers, employees, taxes, etc. These are not things that you can see that come screaming out, popping out from the other financial statements. So generally you don't see the direct method, which is why I don't test you guys on the direct method. So those are all the notes from 11.3. If you have any questions, please let me know.